Hello, physician. If you are like many successful physicians, specialists, and practice owners who seek our advice, you may have accumulated 1 million, 5 million, 10 million, or even more inside your professional corporation. At the beginning of your career, the challenge was making money. Hey, today, the challenge is different. The bigger challenge is how to access, preserve, and transfer corporate wealth without creating unnecessary tax leakage. Many professionals focus heavily on tax filing, but tax filing looks backward and tax planning looks forward. For a successful business owner, the difference can be worth hundreds of thousands or even millions of dollars over a lifetime. You may want to use corporate wealth to purchase a larger home, upgrade your lifestyle, help your children, build retirement income, reinvest your new corporation, new opportunities, or create a stronger family legacy. The common solutions, I would say, is simple. Hey, I will pay myself a dividend or a salary. On the surface, that sounds reasonable. But once corporate wealth moves into your personal hands, the tax system may begin taking a significant share of that money. You agree? For many successful professionals, dividend taxation can approach 50%. That means $1 million is withdrawn from the corporation. Nearly half may disappear before it reaches your family balance sheet. So let's use a simple example. Assume you are already paying yourself $200,000 annually, and now you want to withdraw an additional $400,000 each year for your personal spending, home purchases, or investment purposes. Assuming a 48% dividend tax rate, the tax cost may alone be already $190,000 per year. Over 10 years, that could exceed $1.9 million in tax. But tax paid today is only the first cost. The second cost is often much higher, much larger. Hey, think, the money used to pay tax can no longer work for you. It can no longer compound. It can no longer generating investment returns. It can no longer support your retirement income. It can no longer be repositioned to your family. Let's say if the opportunity cost is 7% annually, yes, $190,000 is lost for tax each year. What about the long-term impact? The lost opportunity could exceed $2.8 million after 10 years. For 20 years, it lost $8.4 million. Even if you do not withdraw an additional $400,000 after year 20, the wealth lost to the tax in the early years continues to compound. After 30 years, the lost opportunity could exceed $16 million. After 40 years, it exceeds $32 million. And this is why the real cost is not only the tax paid today. The real cost is the decades of loss for money that could have remained invested, structured, or repositioned more intelligent. And that is why we call financial leakage. Small leakage can sink big ships. Many business owners tell us, hey, my accountant told me to defer tax and leave the money inside the corporation. That may be reasonable at the beginning, but it is not the complete strategy. You agree? Once your corporation has accumulated significant surplus, the real planning question becomes, after tax has been declared, what happened next? This is where many business owners are underachieved. There is another important issue, the small business deduction. Under the Income Tax Act, the small business deduction is generally funded under ITA, the Income Tax Act, Section 125. Many Canadian-controlled private corporations may benefit from the small business deduction, right, on up to $500,000 of active business income. However, the passive investment income rules, including the ITA Section 125 subsection 5.1, once adjusted, once the investment income exceeds $50,000 annually, the small business deduction begins to go down. If passive income becomes too high, the small business deduction can be eventually be eliminated. This means corporate investment is not only an investment decision, it is a tax planning decision. A business owner may think, I'm simply investing retained earnings inside my corporation. But from a tax planning perspective, the way the corporate surplus is invested may affect future corporate tax rates, personal cash flow, retirement planning, and estate value. This is why advanced planning must consider more than return. It must consider structure, It must consider assets. It must consider tax integration. It must consider shareholder loan rules under ITA Section 15, Subsection 2. It must consider interest deductibility under ITA Section 20, Subsection 1C. It may also consider financial expenses rules under ITA Section 20, Subsection 1E, capital dividend accounts planning under ITA Section 89, Subsection 1, and long-term estate consequences. You agree? The challenge is not simply knowing this provision exists. No. The challenge is knowing what they interact. That is where proper planning leadership matters. Successful business owners are busy building practice, leading teams, and managing wealth. But ultra high net worth families think different. They do not rely on random advice. They build a professional team. A team that can coordinate tax planning, wealth strategy, financial insurance, legal structure, and estate planning. Once your corporation sold $1 million, $5 million, or $10 million of surplus, the question should not be, how do I save a little tax this year? The better question is, how do I build a structure that can serve my family for the next 10, 20, 30, or 40 years? This is where the conversation becomes exciting. Because the answer may not be simply pay yourself more dividends or salary, and it may not be simply leave everything inside the corporation. There are other ways to reposition your corporation surplus, create cash flow, flexibility, access capital, and allow wealth to continue compounding more efficiently. These strategies require careful design. They must be reviewed with property tax, legal, lending, insurance, and wealth planning considerations. But for the right family, the difference can be substantial. As I often say, if you think it is expensive to hire a top specialist, wait until you hire an average one. A successful person would never accept average care for their own family. So why accept average tax and wealth planning for your family's future? The most expensive tax decision is often not the tax you pay. It is the advice you never received. At Guardian Trust GT Wealth, we encourage successful owners to think beyond tax filing. Think about tax-efficient wealth accumulation. You agree? Think about tax-efficient wealth assets. Think about tax-efficient wealth transfer. In part 2, we will compare two common approaches. Taking money out immediately through dividends. Take money out immediately through dividends or salary. Versus deferring withdrawals and leaving funds inside the corporation. How some successful professionals will position corporate surplus. The collateral strategy may create additional flexibility and cash flow. Why some families view these strategies as powerful retirement lifestyle. Legacy planning. If you would like access to part 2, complete the 30-second priority gas registration below. Once completed, you will immediately receive the next video and learn why some high net worth families do not simply withdraw dividends or salary immediately, and what alternatives may exist. I look forward to seeing you in part 2.